Hey guys, it's Navi with TendieTrader. How are y'all doing today? Welcome aboard. Today we're going to do a quick bite of information when it comes to options trading, and today's topic is 0 DTE options. You've probably seen this phrase thrown around online, Wall Street bets, wherever it may be. Let's dive into it a little bit, and I'll show you guys some quick pros and cons, as well as explain a little bit about what they are. Before we dive into it though, don't forget to hit subscribe below if you enjoy this video. Ultimately, it gives us a lot of great feedback on what type of content is helping our subscribers the most. And if you have any questions, don't hesitate to leave a comment below as well, and we'll try our best to get to them. All right, so 0 DTE options, what exactly are they? Well, DTE is a common acronym in options trading for days to expiration. So 0 DTE is essentially 0 days to expiration. So that means the option is expiring that day. What does that mean? That's for most people, people are buying 30, 60 days out. You hear a lot of feedback around, the time decay, theta, all these great things, and why it's better for you to buy options further out so that they have more time to make actual substantial moves. Well, the funny thing is 0 DTE is very risky when it comes to trading, but they can also be highly profitable. And to dive into it, there's a few pros and cons around these. First and foremost, if you're new to trading and you don't have a huge bankroll or portfolio, it lets you get into some of these great companies that are highly volatile and have a ton of volume for cheap, right? So, Tesla, Amazon, Shop, think of those massive tech stocks that you can't necessarily buy 30 to 60, 90 days out unless you have a lot of money to place into that bet, right? Well, if you buy expirations that are either the same week or even better, the same day, the premiums are a lot cheaper. So you can actually get in and capitalize on the volatility of these stocks at a much lower cost point, right? And they're extremely great when the market is moving in one direction. There are those random days, and we all have seen them, where everything is green or everything is red. And then when you pair those type of days, ideally Fridays, because a lot of these are not going to expire on any other day, but when you pair that type of market movement with some of these stocks where they are making extremely big jumps up or down throughout the course of the day, um, you're going to be able to make a small bet turn into a very large return, right? The only problem is with 0 days to expiration, you know, time value exponentially decreases the closer you are to expiration. So the unfortunate part is don't hold it till the last second, because if you buy in the morning and you sell in the afternoon, you're losing a ton of value just simply due to time, right? The closer you get to market close, at the end of the day, you don't have much time value left, right? The second component of that is there's increased gamma risk for options as they get closer to expiration. And essentially what that means is an option's value will swing faster in both directions during those final days until expiration or until that final day of expiration. And then that could be either good or bad, right? Because if it moves in the direction that you want, then that's fantastic because you're essentially going to see the value of your option increase at a much faster rate than if it was 60 to 90 days out. But the other bad part is if it doesn't move in the direction that you want, it could quickly become a worthless position to hold. So the important thing to realize here is that pairing increased gamma risk with the entire market moving in one direction is critical, right? Because if the value of the option is increasing faster or uh, decreasing faster, well, it's great to know that the entire market's moving in one direction, be it SPY, Tesla, Amazon, whatever it may be. At least you know that since everything is trending in the same direction, you can buy a call or a put, and you're going to see that massive increase in value if it does end up playing out as you predict. So it is at the end of the day a very risky strategy to employ, 0 days to expiration. But if you are careful and you do get a little bit lucky, there are ways to make massive returns in the market. So hopefully that was a little bit of a explanation into what 0 DTE means. Um, if you ever see that on the interwebs ever again, hopefully you have a better understanding of what that person is talking about. And if you do have a better understanding now, don't forget to hit subscribe and visit TendieTrader.com. Tons of great content, articles, videos around getting into options trading and what all these different words, strategies, synonyms, acronyms, what all this means, and help make it a little bit clearer for you to make those tendies. All right, guys. Well, thank you for joining me today. Hope you guys learned something valuable, and I'll catch you all on the flip side.